So wonderful good afternoon. So far, any slides okay? Therefore, brought some printout too, just in case somebody didn't have time to print them out. I don't have enough for four, right? So I should say these slides, I didn't print out all the slides simply because it's too much paper and we will skip some slides today anyway. I'll make it that at least some of your neighbors either have a computer, tablet, or the slides available that you can follow with. What's the fastest way? Let's do it via .cam. Very good. I was just looking, I had the feeling that we didn't finish last week, but we just speed up, correct? Was anything missing last week? Any questions regarding the issues from last week? Everybody happy? Very good, that makes me happy. That means we can go straight to this week. New topic. So today we have quite a lot to cover. Some of the slides we will skip. That's the reason why the printouts are not identical to what I will show you here sometimes. Some of the slides you won't have as printout, but these are the slides that are basically not that important anyway. And I will tell you once we're going over it, what's more important, what's less important. Just in case some people are still short on printouts, but these things are unfortunately not stapled, so it's a bit of a pain. Right? Up to 12, page 12. Good. So this time we don't have a Braku chapter, but these are available, I think, via the library. Anybody tried that already? So now this one is even freely available on the internet, and I'm quite sure the library has scanned these in if you want to read up on these topics too. There's some internet links that we will use later as well. So what do we want to talk about today? different types of bonds. You know that we talked about bonds in the past already. We do a little bit more detail today. Then we talk about tenders of treasury bonds. So tender is when the US, not the US government, when a government is issuing bonds for the first time. That's going to be a little bit tricky, I can say already now. Credit rating is pretty much straightforward. Trading bonds through dealers is going to be straightforward. Securitization, that's going to be another tricky topic, and I have to be careful with timing later when we get there. And we skip this part here with the GFC. I will give you another source for that one, and we talk about it a little bit later when we have more advanced knowledge. And we also skipped for today the capital note. So actually you can feel free to cross these out of there. And I received an email that it's not easy to read when I write onto this one. So that's later. That's not very good. Good, starting with bonds. So we talked about bonds in the past. Bonds have a face value. I'll go straight to bond. So a bond has a face value. That is saying how much money you get back later when it's mature. I know what it is. Let's turn the light off. It's got a certain maturity date, and there's a certain amount of coupons attached to the bond always too. So that's basically all that it says here. So I reckon it's always very useful that you imagine literally that picture. Thank you. Good. All kinds of financial companies and the governments can issue bonds. CGS you will see very often in the news, or if you look at financial data, that is Commonwealth Government Securities. So that's what they basically mean by government bonds here, CGS. There are bonds that have fixed payments. So in that case, the coupon has a fixed amount printed on it. That's what we had here in our example in class 2. Often coupons in Australia actually paid every half a year. So that means that if you have, for example, a 5% coupon, you get paid twice $2.50 in that year. So for the whole year, it's 5% or $5, but really you get $2.50 in the middle of the year and $2.50 at the end of the year. Or I shouldn't say middle and the end. Basically, after 6 months after issuing, and then the next one after 12 months after issuing, then 18 months, 24 months, and so on. So that says on paper how much money you're getting. However, what can happen is that there might be a default. Now, we haven't talked much about defaults in class yet. What is a default? Default basically means that the issuer is not going to repay you for whatever reason. They might be still alive, but they simply don't want to pay, or they don't have enough money to pay. And I want to make that a little bit more practical. But it's not working as easy as I hoped for. Yeah, like this one. Just as you see, number one, that these things happen, and number two, what kind of impact they have as well. So Argentina used to issue government bonds in the past, and that is actually in US dollars. and then they earned too little money in tax income, or rather oil income at that time, to really repay all their coupons and to repay the bonds. So they basically defaulted. They say, sorry, I know we promised you that we repay you in 2013. However, we don't have enough money and we can't repay you. Now, if somebody is not repaying their debt, let's say you lend your friend money and he says, sorry, I can't repay you the money. I'm really sorry, I don't have any cash. But he drives a nice car. What kind of idea might you get? What should your friend do? Let's say you saved all your money, you didn't have enough, you lent him the money instead of buying your own car, you always use a bus. Now he's got a car and he's not repaying his money, your loan. What might you want to ask from him? Give me the car, right? And that only happens between friends, that happens between different countries, or rather in this case a country and a private investor too. So Argentina didn't repay its bonds, and the bondholders, especially the bondholders in the US, sued them. And they sued them in the US and said, listen, you guys have to repay us. And the US judges, of course, saw the bonds. The bond said, we promise you to repay, and the Argentinians didn't. So the US judge says, well, feel free to grab the stuff. So what they were afraid of here, the Argentinians, is if they take their Air Force One, their Tango 01, basically on a flight to, I think, somewhere in the Middle East, they were afraid that then the Middle Eastern governments ground the plane and say, well, there's a US court decision out there which says the plane should go to the initial investor of the bond. So what these guys here did is they just left the plane at home and always fly now private. And there was another, I think, Argentina might have government airline as well, where they actually did ground a plane in the US, and they just kept the plane. And also, I think here in the article it says somewhere that they caught a ship in the past. So here in the past they had a fancy ship, and that was traveling around the world, and in Ghana the ship got stuck, and because the New York judges said, well, this ship go now basically to the investors. Instead of getting the bond repayment, they get the ship now. So that is what's meant by a default. Default is you don't repay your bond, but therefore, of course, you might get into legal trouble because you have to, or you shouldn't repay the bond. Trick question, what do you reckon is more worth, the bonds or the plane or the ship? Bonds most likely, right? So it's very unlikely that if somebody's not repaying you, that they have so much assets that you can capture that it's fully covering the debt that they have with you. So usually when something's defaulting, it means that you as investor, you might get some money back by getting ships and boats and cars and whatever, and you can sell them, but it's usually not all the money that you were owed. So you make some losses. That's what's meant by default. Good. So in default can happen at the very end, when the face value is due, but it can also happen in between with the coupons. What can happen is that, for example, Argentina says, well, maybe in 20 years' time when the bond is due, we can repay you, but right now the coupon of, let's say, 2.5, we just don't have the money, we can't repay the coupon now. That can happen as well. So there's always risk associated with bonds. So an example, we have 3-year bonds with a coupon rate of 10% and a 3-year bond with a coupon rate of 14%, both of them in Australia. In Australia, as a rule of thumb, these are semi-annual payments. That means we don't get paid 10% once a year, but we get paid 5% twice a year. Trick question for you. Here we get paid twice a year. 7. Right? Simply this one divided by 2. And that's the reason why we've got here on the time scale 5, 5, 5, 5, 5, 5, 5, 5, 5 for all the coupons, and that at the very end after 3 years. So after 6 payments, hopefully, half a year, 1 year, 1.5 years, 2 years, 2.5 years, 3 years. After 3 years, we get the coupon payment and the face value, if everything goes well. Same thing here, 7, 7, 7, 7, 7, 7, 7, the coupons, and then after 3 years, 7 and the face value, if things go well. And now let's think of what else we get out of this information. Out of these 2 bonds, so this is basically your turn now. This relates to this slide. No need to do any math right now. Don't get shocked by that formula. We basically won't do that formula here. We'll talk about that a bit later. Out of the 2 bonds, which one is better for the investor? So just do that quick with your neighbor. These questions should be fairly straightforward. So this should be, maybe just do all of them with your neighbor very quick. This one, here as well. Then here it's getting much more trickier. So this one you can either calculate, but we don't need the calculation for our class right now. Or you can just make an estimate, just if it's more or less, then I'm happy enough. Let's do that quick. I want you to talk to your neighbor. So that question relates to these 2 bonds. All you have to remember from this side is 10%, 14%. Good, and I go around a little bit, give you a bit of a nudge. So back on. Yes, here we've got another example. So that looks a little bit more difficult than the example that I tried with you, but the principle is exactly the same. So that's from last year, August, and these are real numbers from a real tender. This is the so-called tender number 993, right? So now this is the series. So you can actually put that into Google, Commonwealth Government Bonds, TB148, and you will find exactly this bond. This is a real existing bond, which has a coupon of 2.75%. So you can see Australian interest rates, Australian yields currently, well, coupon rate is not the same as yield, but interest rates are low. It's due in 2027, 21st of November. This is how much money the face value was offered to the public. Total amount allocated, so this is how much they were able to sell. So they were able to sell all the bonds that they had. There was nothing left over. Since we're on that one, times covered, that means all the bids that were coming in. Remember, 1, 1, 2, 2, 3 million, 4 million, right? And in the end, in my example here, we had more million in bids. So we had 1, 2, 4, 6, 10, 14. 14 million you guys wanted to buy off my bonds, but I only had 10. So I was by 40% overdrawn, right? 40% people, 40% more I could have sold, but I didn't. I only had 10. Similar here for the real government. There were 3 times as many bids than they wanted to sell in bonds. But of course, not most attractive bids possibly, right? So people say, yes, we want to earn 14%, for example. And the guys say, it's a bit much, right? So we have other people, they are happy to give us less. So what ended up to be here the different bids? Well, we don't know. That's of course secret, right? Because otherwise we would know that Westpac is the stupid one that was happy with really, really low yields, and somebody else, MAP, was the smart one that had the much higher yields for the same bond, right? So they don't publish who's getting how much, but they do publish the lowest yield and the highest, right? So this is the range where all the winning bidders were sitting. Just as for us, the range was the lowest was 2% and the highest was 9% here. So we were sitting between from 2 to 9% yields. Here they were sitting from 2.62 to 2.63 yields. What else is interesting here? So that's the average yield, weighted average, because not everybody was bidding for 1 million, 1 million, 1 million, 1 million. Some people might have bid for 4 million. And of course, a 4 million bid counts for more than the 1 million bid. So that's what's meant by weighted average. Good, I think that's enough in here. Basic idea clear? So that's a tricky one. I think you probably practice that in the tutorial too. Don't take that one too easy. Important. There's just more examples, and I don't have time. That's the reason why I grade them out. Corporates. So corporations do the same kind of thing. There's different ways they can do the tenders. Number one, they don't usually do the discriminatory price tender. So basically here with the corporations, if you have a bid, it's more like a market price, and then everybody is getting the same yield. What else do we have here? The government is doing it via the Australian Office of Finance, blah, 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 blah. But corporations, they have to do it via investment banks. So they go to Macquarie or Westpac's investment bank arm, and they say, listen, we want to issue bonds. Of course, we as a corporation can't go alone to the bond market. We need your help. And then the investment banks are helping to issue these bonds to find buyers. What else is interesting here? There is the so-called underwriting possibility, underwriting agreements. That doesn't happen too often. Now, what does underwriting mean? Underwriting means that not only does the investment bank promise we help you to sell these bonds, but the investment bank is saying, listen, if you have trouble selling these bonds into the market, we buy all the leftover bonds at a certain price from you. So in that case, with underwriting, it's guaranteed for the corporation that they get rid of all their bonds, or more importantly, that they get enough money in. And what else do we have here? Spinning. I want to talk about spinning just very quickly. So oversubscribed means that there is more bidders now than we have bonds available. Just as we had beforehand here, we had the last bidder with the 4 million. I only had 1 million bonds left over for you. But we discriminated, so we make a ranking. The one with the lowest yield gets the bonds first, and then the next one, next one, next one, next one. Here with the corporate bonds, it's differently, right? So here, everybody's getting the same yield, so we don't discriminate between the buyers. And if there has been overwriting, so if there have been more bids, more people wanting to buy the bond, even at that high yield, then we have to allocate these somehow to them. And we can do it discretionary. That means we can choose. And now you can think about it. What might go wrong here? Let's say you're the investment banker, and your friend wants to buy lots of bonds, and a stranger wants to buy lots of bonds too. What would be a dodgy person doing, which is at the same time possibly a good friend? Sell the bonds to the friend, right? And if you're not directly friends, maybe even some extra money is flowing, or maybe you get an invite to a nice restaurant, or you might get a customer that is saying, listen, if I ever want to issue bonds, I do it via your company. And that's, of course, dodgy, right? That's pretty close to corruption. And that's what we call spinning. So that's the reason why that part is a little bit iffy. Good. Book building. I want to save time because I really want to get towards securitization, which is a more interesting topic. So I suggest you should feel free to cross this one out. Credit rating agencies, that's a little bit more interesting. So now, if you buy bonds from the government, we're pretty sure the Australian government is repaying us. But Argentina, for example, is not so sure. Argentina already in the past several times, they simply say, no, we're not paying our coupons, we're not paying back the face value. So you as an investor, you want to know how much risk is there? How is the chance that they're going to repay me? And that's, of course, very hard for you to estimate. That's the reason why there are specialist companies there, S&P, Fitch, Moody's, and co. And they're checking out these countries, they're checking out corporations and give them ratings. A ratings are very good, best quality. C's and D's, not so good, right? So some of them might have defaulted in the past, or people think that they might go to default. Now, why are these ratings super important? If a company is very risky, do they have to pay a high interest rate or a low interest rate to attract investors? High interest rate. So if your company used to have a AAA rating, and now S&P and Fitch say, listen, we're not happy with your company policy, we might change it towards a AA rating. What's happening then to your cost next time you want to get money in the market? Increases, so you're not happy about it, right? So these ratings, even though they're just stupid letters on a piece of paper, they have a huge impact on financial markets, and they're very important for corporations. And a few years back, if you watch the news, right now it's not that big on the news, I think 1 or 2 years back, they were thinking to rate Australia possibly down, so they had a negative outlook, it's called. That means they're not getting an AA yet, but it's not a real AAA yet. There might be changes in the future. And then, of course, all the politicians were going nuts. The opposition is always blaming the government at the time. Right? The government at the time says it's your fault because when you were in government 5 years ago, you spent too much money, and now we have possibly a downgrade coming up. So ratings are important. We can look at some ratings. And of course, the link doesn't work for me here. Now let's skip that, save the time. So it's maybe interesting to just look at how the ratings are. So AAA ratings, once you guess not there, it should be surely there too. Anyway, Australia, Canada, Germany, so the typical things that you would expect there. Junk bonds, so junk means they're starting to get dodgy, right? Venezuela, Puerto Rico, worse, I'm a bit surprised. I'm quite sure there's things like Syria, for example, right now. Any area where there's war, clearly they don't have good rating, right? Or if you think of Iraq, just to see how practical these things are. Iraq, Saddam Hussein in the olden days bought a lot of money and had lots of deals with European countries. And you can imagine after the American takes over, what happens to all these Iraqi bonds when Saddam Hussein is out of the business. Is the Iraqi government still repaying the old bonds to the French and German companies? No, right? They all go to the bin. Very unlikely if you have a regime change. If there's a big change in, so not just an election, but if there's a proper regime change in the country, most likely the bonds become worthless. So you don't want to necessarily invest in a country with an unstable political system. Bonds trading, let me see, OTC. So what does OTC mean? OTC means over the counter. Maybe I should write that down. Is that written down here somewhere? No. So OTC, over the counter. Now, where is that coming from? I'm imagining that always the following way. There is markets where everybody's meeting in a centralized market, like this share market, for example. So all the buying and selling orders, for example, for the Australian ASX share market, they're basically all flowing to Sydney, to a central spot, and there the buyers and sellers virtually meet, or we are the dealers and brokers, there's a meeting there, and all these different orders come in. Right? And now you look at all the buyers, all the sellers, and match the prices just with supply and demand, like we've learned in economics classes. OTC is different. There's not a central meeting point. And there's not also lots of buyers coming in, lots of sellers coming in. It's kind of one-on-one. So it's over the counter. Somebody's coming to the counter. I'm a potential buyer. This is a potential seller. We agree on the terms. Handshake, done. Then the next year, somebody else comes to the counter. I make a deal with them. I don't compare these two beforehand. I make deal by deal. Or how it's done practically in the past, over the phone, basically. Right? So that one bank is calling the other bank. You might see that in Wolf of Wall Street or some other Wall Street movies, right, where they're calling margin call. I think they've got that too. So they're calling their colleagues at another bank and say, listen, I want to sell $2 million worth of bonds. What's the yield that you're offering? And there's no market involved. It's one-on-one in that sense. Nowadays, it's of course done all with the computer, but the same principle. It's not that the computer is collecting 100 orders here and 100 buying orders there and then matches them. It has one buying order, one selling order. If they agree, done, next one. One, next one. Right? So that's a big difference between OTC and regular stock markets. And there are certain markets that are done via OTC. Foreign exchange market is the most famous one. So basically all foreign exchange deals are done via OTC. Then we've got here the Australian government bond market is traded via OTC too, and the corporate market as well. That's a little bit of technical stuff here. So who's doing the clearing? I don't want to go into that much details. So for the time being, we can cross that out here too. This one though, just for itself, that might change in the future. Currently it's T+2. What does that mean? Trading date. So if you're selling shares right now, it takes 2 days, business days, till you get money onto your account. Which is really, I think that comes from the olden times when they were still riding with a horse between the different banks, right? So that's clearly too long nowadays. And they're changing that too. So if you're a very large institutional investor, it's actually real time already. And for us smaller investors, you can see it on the rise, and sooner or later it's going to be 0 days. But currently, maybe keep in mind if you have a credit card bill, just very practical, right? So I had shares, for example, too, and my credit card bill was due, and my credit card is with a different bank than my account that is linked to my shares. So it takes 2 days when I sell my shares to get the money onto my account, and then takes another 2 days till it goes from my account to the credit card. So I have to think 4 days in advance, which is actually quite a long time. It's ridiculous. But things get better, so nowadays we get more and more towards real time. What else do we have here? Yeah, let's do that very quickly. So OTCs are wholesale markets. You can imagine you don't have access to the computer system where you can sell your foreign exchange or your bonds directly to Westpac. So it's all the big institutional investors, meaning wholesale markets. And then also we have so-called dealers. The dealers are often market makers. And what does that mean? Sometimes the dealer is buying shares with his own money. So he's not buying it for a client, with the client's money, but with his own money. But the idea is not that he's buying the shares and speculates and holds it for several months. He's just buying it usually for a few hours or a few days. And then if another interested buyer comes in, he immediately sells them again too. The whole point there is to make the market. So the idea is if somebody now wants to sell their government bonds, and in that very moment the market is very thin, So there's no other buyer for these bonds. The market maker says, okay, I just buy them off you. Sooner or later, there will be another buyer again. Right? And it says here, not to be confused with proprietary trading. So proprietary trading means that financial institutions are buying and selling shares, not for their clients, but to make profits out of it. And there's the difference. So the market maker is just buying and selling his own shares and with his own money, so the market is working better. And there's proprietary trading. Institutions are not doing it for the market, but they do it for their own profits. You can see I'm flying through these things. There's a lot of definition on these things. I want to actually get to something more interesting. I think there might be tutorial questions for these. So I'm not saying this is unimportant, but we push that one to the tutorial or for your own practice. Corporate bonds, that is grayed out, means we can skip over it. Skip. So securitization, that's the one I wanted to come to because that's more exciting. So surely you have heard about the global financial crisis, and I imagine you would have heard about subprime debt, securitized debt, all these things. And there's something actually that happened that was very, very interesting. We don't have enough time right now to talk about the global financial crisis, but we can talk a bit about securitization. So what's the idea of securitization? Banks have loans on their asset side, right? So we have a bank here, and they have lots of loans on the asset side, lots of deposits here, and some other stuff too. But with loans, you have to wait a long time till you get all your money back, right? So if somebody has a mortgage, for example, that runs for 20 years, you have to wait for 20 years till the loan is repaid, right? So you get stuck with that asset for 20 years' time. Plus, banks are not allowed to give an infinite amount of loans. There's certain bank regulation that we will have later in class, which says you have to limit your amount of loans. And then banks got a clever idea. We want to sell these loans, sell, and get funds in, right? Exchange settlement funds, for example. That would be fantastic. But of course, the problem is you can't sell a single mortgage. Nobody is going to buy a mortgage that says, well, Axel is going to repay $300,000 in 20 years' time. Nobody's interested in that. And that's where securitization comes in. So securitization, they're not selling a single loan. They're bundling lots of different loans together. So I'll just give you a little bit of picture. So what they're doing here is they do lots of different loans, millions of dollars worth of loans, all into one portfolio. So they make a basket of these loans. And then instead of selling the loans, so where it says Axel or Ben or Marie or whoever is repaying something, they're just saying, listen, you get paid every year a certain percentage from all these loan pools, and after 20 years you get all your money back, basically. So certain cash flows, and they're coming from these loans, but we're not interested in the individual loans, just in the whole portfolio. Right? Step one, that's a basic idea here. Everybody on board? So you just put all these loans into a big basket, and then basically sell the whole basket. But that by itself is not interesting, right? So it's getting a little bit more into detail. Number one, how do we do it in detail? First, we need a so-called special purpose vehicle. The whole idea of a special purpose vehicle, it's a little bit like a mailbox company, right? So it's a legal setup on paper. There's no headquarters, no buildings involved, right? It's just on paper legal company. And that legal company now buys all these loans. Trick question, how can a paper company afford to buy $1 million of loans? Let's say, for example, if you've got Bear Stearns, the bank, and then you've got a SPV Bear Stearns. Just take a guess where SPV Bear Stearns gets money from to buy the Bear Stearns loan. From Bear Stearns, right? That's the easiest way. And that's what we're doing now too, step by step. So, we're starting with this one here. This is before we have any securitization. So we have a bank, has lots of mortgages or loans on this side, lots of deposits. And plus means they did lots of new mortgages, not lots of new deposits. They might have financed some short-term borrowings or two, but that's not important. Now we start the securitization process. So the first step is we are creating an SPV. And now that SPV, we are selling our mortgages to. So all these loans, we're selling to the SPV. But the SPV, of course, can't afford to buy all these mortgages. So what we're doing at the same time too is we give this SPV a loan, right? So we're creating a deposit that we give to the SPV, and the SPV immediately repays us the deposits too. If that is too confusing, let's take a practical example. You're the SPV, you don't have anything, right? But I want to sell you my $4 million worth of mortgages. But you don't have $4 million, right? That's the problem. What I do is, I give you $4 million. Can you please buy my bonds? My loan? So that loan is liquid for a very, very short time. So now you guys still, you gave me my deposit there, but you still have the loan. Because now you've got an asset. You gave me the deposits, but I still have on my books the loan. I still have no asset. I borrowed. Already, that was not the key example. It's because we have one financial instrument missing. So now we make. So we start again with 0, right? I want you to find these $4 million, but you don't have it. So we make a loan contract. So I give you a loan, but of course that means you have to sign a loan contract. Don't forget to sign. So now we've got a loan contract. I gave you the deposits at the bank, right? But remember, on my asset side, I've got now the loan, which is this loan to the SPV. So you promised me, so you give me an iPhone in the future. You give me $4 million in the future. That's a loan. That's a repayment. Right? Step 1. Now I take my $4 million worth of my customer loans that I wanted to get rid of, give them to you, and you pay me $4 million. Right? So that is what I've meant here by the deposit payment in this moment. Coming back here. But here it is. So the mortgages are with you. So the mortgages are away of my balance sheet. But I still have that contract. So you're not off the hook. Right? The $4 million that you just gave me, they were not repayment for the loan. They were because you were buying the bonds. You still have the loan. I still have that loan contract here in my hand. We didn't swap that back. And that's what's sitting here. And you have it, of course, as a liability. Oh, yes, that's getting harder, though. We don't do money, numbers in here. So you're right, there's some profits and losses going in between, but we don't do that now. I just want to get the idea of securitization across. Otherwise, we're getting too much into the nitty-gritty. So we're not finished yet, because you're just the SPV, right? So what's happening next? That's during securitization. So we have now a loan contract with us. The whole idea was, of course, to securitize these bonds, these loans, and sell them off to other people. So what's happening now is you do some magic trick with all these bonds, and you just sell them to the rest of the funds against cash. That just pretends, you just need to think for a second. Right? So now, and therefore you get the bonds. So you know an investor, you, for example, a city in Ireland that bought lots of subprime mortgage bonds. And you pay cash to the SPV. And now comes the beauty. because you now get the spare cash. You can repay your loan. I get the cash at the bank. You get the loan from the bank for it. So what we have done now, you get it back in a second. I got the cash. Cash between banks, remember, is ESF. So I've got real funds now. That ended up with me as a bank. Because you got the real funds from the private investors, and you used these real funds to repay your loan. So the loan contract between us is gone. I gave it back to you, right? That loan contract is gone. And this is the way how indirectly, let me see, I've got a picture here too. So from the investor, you were the investor there, money, the pen, was flowing to the SPV, and from the SPV then to me, the originator, the bank. And from me, the bank, the loan contracts indirectly were flowing to the SPV. You have all the loan contracts, but you made out of these loan contracts so-called asset-backed securities, so you made new bonds that you sold to the general public. That's what happened. So that's a basic idea. That's the same thing, just a little bit more complicated. How we use time. Okay. So we need a little bit more details. So because up to now you would think like, yeah, that doesn't sound that too exciting, right? So basically they sold the loans. But the question is, if people didn't want to buy individual loans, why are they interested to buy a whole basket of loans, right? That doesn't seem to be too much of a difference. Well, let's think about what's happening here. So first thing is, there are mortgage-backed securities. So these securities now that got sold to everybody, there's collateral behind them. The houses of all the people that built houses and got the mortgage loans, they are their securities. So if something goes wrong, you can always kind of grab the value of the houses. But then, of course, how important that is depends upon how much the house value is. And you can see already here now how it links up with the global financial crisis. As long as house prices go up, there's no problems with these securities. Because even if some of the loans can't repay, there's always the house that is worth a lot that you can use. But if house prices go down, then things get tricky. Because people can't repay their loan, you get the house, but the house is not worth as much anymore. Then there is the credit wrapping that we did here before, and so other banks did a guarantee on it, right? But that's also not that exciting. The really exciting part is this one, tranches, and that is actually something more advanced here too. So that's often in advanced finance classes, and I reckon that is, hopefully you see that too, a real aha thing. So that's a bit tricky, time to wake up. So what does a tranche mean? Let's say all the different loans that I gave to you, you're kind of now slicing up into different tranches. But here's the important thing, you're not sorting the loans for good loans, medium loans, bad loans. That's not what we're doing. What we're doing is we're saying we have 120 in total worth of loans, and we make different securities. We make a senior tranche security, which is the safest security, a junior tranche, which is sitting in the middle, and a bad security. Now, what makes a good and a bad security is not the underlying houses or loans in this example, but it's how we distribute the cash flows. And the best way to think of it is of this one. So the cash flow is literally the water that is coming down. We're hoping that we get all the water back that we were calculating with. We're hoping that we get 120 liters of water, for example, right? 120 to repay, that all 120 in loans get repaid. Forget about interest right now. We hope to get all the face value back of these loans, 120. Then we could pay 70 to the senior tranche holders. We could pay 30 to the junior tranche holders. We get paid 20 to the equity tranche. Everybody's happy. Everybody gets money back. But what can happen is it's raining less. Not everybody can repay their loan. The economy is going down. Turns out only $100 from the $120 get repaid. And now it's getting interesting. If it's raining less, But if it's, let's say, instead of 120 liters, it's only raining 100 liters. What happens to the first bucket here? Is it still getting lots of water? Yes. Second bucket, some. Depends upon how much rain we had, right? But the last bucket, what's the chance here? Gets less water. Let's do that properly now with the finance, right? So if out of the 120 we only get 100 back, then we have the senior tranche. Is there enough money to repay the senior tranche? Yes. So they get $70 back. They're happy. How much money is left over? 30. So it's enough for the junior tranche. They get all their money back. They're happy. How much money is left over now after we repaid the senior and juniors? Nothing. And here's the kicker. How much is the equity tranche then getting? 0. How much in percent did they lose? 100%. See how the risk is differently spread? If you would have just invested in all the loans here, you would have lost 20%. Or not 20%, but you know what I mean, right? Out of 120, you would have gotten back 100, so you would have lost $20. If you personally buy senior tranches, in my example, how much would you have lost? Nothing, right? That's the kicker here. And that's the reason why the senior tranche is AAA. Do we have the ratings here? Here. Right, so here's the same idea. Senior, mezzanine, equity tranche. So the top tranches, the senior tranches get top ratings. Because even if some of the loans go bust, as long as there's enough money coming in, they get fully repaid, everything. But the lowest tranche, they've got the highest risk, there's not enough money left over. And they can lose a lot. And that's what I want you to do now, very quickly. I know it's the last 5 minutes, but give it a try. Do it in pairs of 2. So 2 people are doing this one, and then the next 2 neighbors next to you try to do the other one, and then you compare. I go around a little bit, give you a nudge, and then in 2 minutes we do it together. In principle, this is quite easy, but till the penny drops in your head, it's quite hard too. So I saw people struggling with that kind of stuff a lot beforehand. Let's try that very quick.